What's up, guys? I hope you're doing well. Okay, so basically, going over the another speech by Fed Governor Waller. I don't know why I kept saying Fred, but maybe because I've been looking at too many of the St. Louis Fred graphs, probably. But anyway, he gave a speech at the end of March, so it's like a month and a half ago or so. But I just kind of fell through the cracks and I never noticed it. Um, so figured we'd go over that, give some data, try to be somewhat superficial in a way, because it's a bit of a long one, and I don't want to take up like 45 minutes of your guys' time or whatever to go through it meticulously. But, anyways, straight into the screen share. So, pretty much just comments on like how the real estate market is a sizable portion of the GDP. In both housing investment and consumption spending on housing services, which is what renters and homeowners pay for the shelter and amenities provided by housing, right? And so, like, housing is a very big industry. Obviously, the U.S. real estate market is, I think it's like the biggest in volume or something in the planet or in the globe. I don't know if it's like volume or maybe if it's just like sheer mass, but I know like a lot of foreigners invest in it too. I'm not sure. I haven't looked up data and stuff. It's just kind of a bit of an educated guess, I guess. From it seems vaguely correct from what I've been hearing on different podcasts and stuff like that about real estate. But anyways, continuing on. Unless you guys have been under a rock, housing prices and rents have gone up significantly, right? And it's getting harder and harder to buy houses. That's one thing I do have personal experience with is I just graduated from college in this past December, so just over about 5 months ago or so, and I moved to Florida for work for what I got hired to do, and trying to find housing was a pain in the butt, to be honest. And like, so I ended up doing kind of a co-living thing with two other guys, basically just becoming roommates because there's no other like everywhere else is just too expensive for someone who's just out of college. I mean, there's no way I could afford like 2 grand and just rent, like a lot of the other houses are here. Um, so splitting it for like a third of that price with three other guys is, or two other guys, I mean, it's better. Um, and I've heard a lot of people, like some of my coworkers who are obviously much older, um, trying to like buy houses and stuff like that. A couple are trying to sell them just because it's been so crazy down here. But anyways, some data on this. So on net, rents have risen 6.5% since January 2022 or 2020. Sorry, according to the prices tracked under the CPI. That is not out of pace with rent increases seen in the CPI over the previous 5 years. They also don't measure rent really. It's like owner's equivalent rent, and it's different. I did a whole post on that specifically on my website somewhere. I forgot what the title was, but it's on there. I did quite a few about the CPI and like some of the exactly how some things are measured. Where actually I have the PDF linked there, and you can see it embedded in the post. Where like the exact weightings were for the different sections of the CPI, and so there's housing in there, and then it breaks down into like owner's equivalent rent. Um, then it has like some, I don't remember exactly off the top of my head. It's been a minute, but anyways, that's on the website. Um, but the one thing, and I kind of I like this guy in a way, because specifically he brings up this, which is why I highlighted it in green. So he says basically, for example, CoreLogic single family rent index rose 12% over the 12 months through December, and Real Page's measure of asking rent for units in multifamily housing rose 15%, um, which is a lot more than the CPI states. So at least he is talking about other units of measure, saying that the CPI is half of what um, the CPI part, or whatever you want to call it, of housing is half of what some other more direct kind of housing prices indices are measuring, right? So like Zillow had a similar number off the top of my head. There's 12 to 15, somewhere in there, in the teens, I think. It's a lot more than 6.5. I've heard some arguments that overall inflation's that has the same story, but we're just not going to go in there. You can look up. It's called Shadow Stats, I believe, is the what it's like shadowstats.com or .net or whatever the extension is. Um, does stuff where that's the website that measures inflation in terms of the CPI from the 1970s, I believe. It measures it differently based off of not what's changed. Ooh. So this other part in green, where I may have misspoke earlier. So house prices are up a cumulative 35% since the beginning of March 2020, um, according to Zillow Home Value Index. So that's even more than 15%. So it's double that. Um, but one of the things that really struck me with this one is he talks about the renters aged 20 to 45, right? That transition into home ownership last year was the highest since the Great Recession, so 2008. Um, it could be that time spent at home during the pandemic. I ended up saying it anyway. Um, made renters more interested in owning a home, or that people are getting help from families or friends with down payments, or that some people are choosing to buy smaller homes than they would have a few years ago when prices were lower. Um, so one thing I'm disappointed in, and maybe it's somewhere in the footnotes, but I normally they have like a little what's it called? Um, I don't know if it's a footnote, but where it got the little number above it, and then it has a reference right below it. Normally they have those, like here, or the superscript where you have three right here where it gives a reference. I wish he had it for, or they put it in here for this statistic, because I want to see like what's the nuance in that, because that's contrary to what I've been dealing with from an anecdotal perspective, various other things. So maybe it's somewhere down here. Um, I don't see anything that jumps out about specifically like that age demographic, but still, there's that. Get back up to that's it for that one. So, basically on mortgages, and basically saying in this area here, based on net rates for 30-year mortgages fell about 1% from January 2020 to January 2021, which helped dampen the cost of rising house prices over the period. And he said like the Fed's involvement in agency mortgage-backed securities, it was like 0.4% decrease is what they attributed to it. Like that's how much the Fed had influence over it. I'm not sure how they measured that, which I'd be interested to read. Um, see if I can find it exactly. Uh, Research shows that the marginal effect of the agency MBS purchases in response to the um, March 2020 shock lowered mortgage rates about 40 basis points. So, yeah. And then it has this fourth one highlighted. So, I'm going to do what I do and eat my words. I'm going to highlight this, maybe, or highlight a section of it so that I can remember to go back and read it so I can share it, um, and look more into that because I'm pretty interested in that. And like I said, trying to keep things relatively quick at least. Um, so let's see. Oh, right. Basically, what he says, and I've heard some, I guess, trustworthy. I'd put them as trustworthy people who actually like have been in the housing market or real estate investors for a long time. People like Jason Hartman. Um, I think George Gammon has said it too. And I've also think I've heard it on the Bigger Pockets podcast. and basically, how this housing bubble is different from the whole Great Recession, 2008 crash, and everything else is the the bubble isn't layered on top of over leverage from entities in general. People are not just taking on a bunch of debt and becoming overextended, right? It has to deal with kind of the same thing with like a supply crunch or however you want to say, supply shock, I think. Um, and also, it's not so much a banking problem as 2008 is believed to be had. The whole subprime mortgage stuff, which I actually listened to a interesting podcast by Jeff Snyder and Emil Kalinowski. One of the recent ones, early May, as where you should look at it. Somewhere in there, I don't remember the exact episode number, but where they talked about how 2008 wasn't really about the subprime mortgage crisis, and that was actually kind of um, a derivative in a way. It kind of derived itself from a euro dollar problem. Um, Something to look into. But anyways, nowadays the banks are more prepared for it. Um, their balance sheets are a lot stronger. There's different regulations in place. We're in a different reserve regime and stuff like that to make things. It's a different kind of the monetary system kind of foundation is different than it is in 2008 in a way. Um, I don't want to say that. The basis on which the housing market and how that kind of interacts with it is different, but it's not so much a problem of liquidity, I guess. Or I should say the banking system, and as it goes into a little bit to a certain extent, non-bank entities are also they're more well equipped to handle any liquidity problems that could arise, um, whereas they were not for 2008. And here, this little highlight. His short answer is that unlike the housing bubble and crash in the mid 2000s, the recent increase seems to be sustained by the substantive supply and demand issues that he's detailed, not excessive leverage, looser underwriting standards, or financial speculation, which is kind of the difference I was alluding to before. Not excessive leverage. They're not leveraging these securities or even the houses themselves to the same extent. Um, Looser underwriting standards. That was those whole ninja loans. I believe that's what they're called. It's like no income, no job. Uh, I don't know if there's a J or I mean a in the acronym or whatever it is. But basically, you can get a loan no matter if you could fog a mirror, you could get a loan at the time. The credit requirements were very low, whereas now they're still not. Like that's one of the options I looked into is like since I've been studying real estate a whole bunch in college and stuff because it's just interesting. Read all like the Rich Dad books for it, bunch of other real estate books. Um, and now that I'm out of college and everything, I was like, can I try to just buy a house, buy a small house, and kind of do what I'm doing here, just from the other perspective, to where I own the house and kind of rent out rooms and stuff like that to help pay the mortgage. But um, I couldn't get a loan anywhere, and haven't figured out, or well, I probably could figure out the whole seller financing thing or other options as well, but just haven't taken the time, so to speak. Not really an excuse, but still, um, just haven't done it, unfortunately. So, yeah, keep in mind, housing is becoming an ever increasing factor in people's incomes or in their expenses. So, that's pretty much it for that. That's all he had to say. Um, did a little bit of superficial work, I guess. Got some data in there, pretty nice. But anyways, that's really all for this one. So I hope you guys have a good night, and I'll see you in the next one.